Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to part one of Tokenize the World, a security token documentary. If you don't know what a security is, let alone what a security token is, we've got you covered because right after this intro, we're starting from the top. I decided to create this series after learning that many of my preconceived notions about security tokens were just flat wrong, and that several individuals I respected and who otherwise were well-versed on crypto assets had misconceptions about security tokens, how and where they attempted to add value, why they might be needed, and the mechanisms of how they worked. And who could blame them really? As my friend Taylor Pearson pointed out in a really long tweet storm, just understanding how cryptocurrencies work means understanding cryptography, distributed systems, economics, and politics. Security tokens add to this list SEC regulations, securities laws, equity mechanics, private and public issuance of stock, and guidelines from over 100 legal jurisdictions. With this in mind, my purpose here is not to convince you that security tokens and asset-backed tokens are valuable or needed, but instead to simplify the complex and tell the story of projects makers, issuers, investors, and influencers driving adoption of security tokens. To create this content, I had conversations with leading thinkers and creators in the field. What I've found is that at every step of the way, the tokenization of securities, real estate, art, and other real-world assets is forcing us to re-examine old habits and ways of operating. This documentary started off as a passion project, quickly turned into a huge time-consuming pain in the ass, and is now back to being a passion project just as it's about to be released. I should mention two things before we end this intro. The first is that I am not an attorney or financial advisor, and absolutely none of this should be taken as legal or investment advice. The second thing worth mentioning is that this documentary is brought to you by the Nomics API. Nomics employs me and is making this content possible, so here's a bit about the API. The Nomics API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. Instead of having to integrate with a bunch of exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you've found that you or your developer have to spend too much time cleaning up and maintaining datasets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomics.com. Okay, let's get back to the documentary, which starts out by addressing two questions. The first is, how have we traditionally interacted with securities in the past, and what needs improvement? And the second is, what's a security in the first place? Here to address that topic is securities attorney Zach Robbins. At its most basic level, what is a security?
The Securities Act of 1933 and then the Securities and Exchange Act of 1934 are sort of the bedrock laws that oversee securities laws, and were both responses to the Great Depression. Today, we sort of judge a security by something known as the Howey test. The Howey test is a four-part test which basically says, is an investor contributing capital? Is the capital being contributed to a common enterprise that relies upon the work of others? And the fourth part, most important part, is there an expectation of profits? And so that Howey test came from case law, and that today is still sort of how we judge a security. The vast majority of securities out there are privately held. Those are, shares in private companies. Those are interests in real estate, in many other assets out there. When I'm trying to explain a security to someone, and it's obviously helpful to describe it in as layman's terms as possible, I love to use the example of Kickstarter, because in 2018, everyone knows what Kickstarter is. And Kickstarter is where you back a campaign, you give money to that campaign, and you never have an expectation, though, of making money off that campaign. Your expectation is that you're going to receive access to a service or perhaps a physical good will be coming back to you. And so that is not a security. Whereas if I were to invest in an investment crowdfunding campaign, there is a clear expectation of profits.
There's some interesting nuance in Zach's comments, but the most essential part of what Zach said is the Howey test as a set of conditions used by the SEC to determine what is and is not a security. I think it's important that we restate this 4-part test. Something qualifies as a security if it involves 1, an investment of money, 2, in a common enterprise, 3, with the expectation of profits, 4, predominantly from the efforts of others. This last part is arguably the most important component. It is key that profits are derived from the efforts of others. That's why a direct fractional ownership stake in real estate generally doesn't constitute a security. And that's why Beanie Babies, lottery tickets, pieces of art, and collectibles are not securities. For more on this, here's a piece of my conversation with Bruce Fenton. Bruce is the owner of Chainstone Labs, host of the Satoshi Roundtable, and one of the leaders of the Ravencoin project. You mentioned that you could have a token that represents a Beanie Baby, and that wouldn't necessarily be a security. The somewhat absurd example of a Beanie Baby might help us get to the core of this discussion about securities. So if you had a token that represented a Beanie Baby, that would not be a security. But if you could have fractional ownership in a Beanie Baby that you believed would appreciate in value, and these sort of tokens that represented fractional ownership were being traded, would that be a security?
No, that's a great question. I'm glad you asked that because that's a common misconception. A lot of people are really misunderstanding what tokens are and how they work and what securities are and how they work. The fact that something is a token doesn't change it at all, whether it's a security or not. That's completely based on just the Howey test. So a Beanie Baby, nobody argues that a Beanie Baby is a security. If you tokenize it, basically something being a security doesn't change its properties. What really matters is what the agreement is. Going back to when we talked about what a stock is, what is the agreement between people? What is the agreement between human beings? So in the example with a Beanie Baby, if you have a fractional Beanie Baby and you believe it goes up, that alone doesn't make it a security, and that would not be subject to the Howey test. That wouldn't be considered a security under the Howey test. Collectibles are allowed. They are not considered securities. You can trade them freely. You could certainly tokenize them and trade them. There's no reason you couldn't. Just because something's anticipated to go up in value doesn't make it a security. Yes, that's one part of the Howey test, whether somebody anticipates that it's going to go up, but that alone doesn't make it. People think that things are going to go up all the time. People were buying ringtones for a while. People buy magic cards. They buy comic books. They buy art. They buy rare cars. None of those things are securities. And the tokenization of something and splitting it into fractions doesn't make it a security. What makes it a security is the agreement between people. So if you're raising money from people where they think that the person's work, that was a key component of the Howey test, a person's work, as in CEOs and CFOs and COOs, are going to do something that will make someone else, the shareholder or the instrument holder, money, that's a very different thing. So if you invested in a company that sells Beanie Babies or comic books and says, we're giving you a token and we're going to buy X number of Beanie Babies and you're going to get a percentage of what we sell or something, those are the kind of things when you're getting into being a security.
Now, what if we kind of take the example beyond Beanie Babies and we say fractional ownership in a piece of Vincent van Gogh artwork or fractional ownership in a piece of property that isn't being put to productive use? Is that also the same thing apply or not?
It depends. The law is complex. So in the example of a Van Gogh painting, sure, I don't believe that would be a security also. Real estate, it depends how it's sold. If it's just real estate in itself, that wouldn't be a security. Real estate is not a security. However, real estate investments can be securitized depending how they're sold. So if I go out and say I want to be a developer and I'm going to raise 100,000 each from 20 people or something, those are the areas where you're likely getting into something that's going to be a security. It depends exactly how it's done. There are ways to structure real estate transactions, which is not a security. We have kind of joint owners and they all own part of the real estate. But what Howey and the SEC and the law is mainly concerned about is when someone is asking someone else for money for something that they are claiming or presenting or the people believe will yield them an investment return based on the efforts of another person. So that's where it really comes down to it. You could buy a Van Gogh, and that's just going to do what it's going to go up or down in value based on supply and demand. Same with Beanie Babies, comic books, Van Goghs, 67 Mustangs. All of those things will be based on supply and demand. Whereas if you have interests in Bob's car repair or Jane's art store or something like that, and you own a 1/1000th of the company, then that is a security because your efforts don't depend on supply and demand. They depend on Jane's efforts as an art dealer or Bob's efforts as a car dealer or whatever. That's one way that it becomes a security. Now, there's other ways too. You could have something where you don't depend on anybody's effort, but because of what the instrument is invested in, then that becomes a security. So, for example, if you buy other securities, you're automatically a security. That's one thing that we ran into with my company. I want to issue an asset management product that would invest in securities. And I spent probably a year looking at the law, and I'm very clever and creative with these things. I love to think outside the box. It's probably my biggest strength. And I have a decent understanding of both the securities industry and blockchain. And I looked and looked and looked and tried to figure out a way around it. There just isn't any way around it, at least for my particular product. If you have an investment that buys securities, or if you are having something that is basically shares of your business or something like that, it's definitely a security. So for, at least in my case, there was no way to try and claim it was a utility token or something like that. So yeah, that's important to know exactly how the Howey test decision works and what they're most likely to look at when they're looking at these things.
So what I noticed during my discussion of securities is that there seems to be a definitional tautology. Something is a security because it's regulated by the SEC, and it's regulated by the SEC because it's a security. Here to help us gain clarity on this is Joshua Stein. Joshua is an attorney and the CEO of Harbor, one of the leading platforms for issuing blockchain-based security tokens.
So there's the tautology of a security is that which is defined as a security under the law. So that's the legal answer of when do the security rules apply. But underneath that, there's an underlying public policy concern. Why do we define certain things as a security? What is it that drives the categorization? And the answer is it's a classic principal agent problem. When you have fractional ownership and you give over your money to someone else to then invest and manage that, there is a principal agent problem where the interests aren't aligned exactly. That's where the regulation springs up so that investors can be protected and that the capital can be formed. And the securities laws are designed to do that. They're designed to protect investors, facilitate capital formation, ensure orderly secondary markets. And it drives out of this principal agent issue where you have to have some level of disclosure and trust of the third party that you're entrusting your money to.
So securities laws were created to prevent fraud and to prevent bad actors from making decisions that negatively affect others. I think Josh's answer gets at the root of this issue, which is that they were created to solve the principal agent problem. The principal agent problem in political science and economics occurs when one person or entity, i.e. the agent, is able to make decisions or take actions on behalf of another person or entity. Professor Stephen McKeon from the University of Oregon has some further insight into the purpose behind these laws.
One thing that's not talked about often enough is that there's a difference between a scam and a bad idea. So regulation should attempt to curb the first, but not the latter, right? Because it's hard to tell ex ante what are the bad ideas and what are the things that are going to be world changing. Sometimes it's actually not obvious right away, right? So what regulation should do is try to curb market manipulation, try to curb outright scams, but not actually try and protect the investor from taking a chance on a particular idea, right? The government authorizes many ways for the general public to lose money, right? They sell lottery tickets, they regulate casinos, and so on. And so I think it's up to the investor to decide whether the investment is good or not, or whether it's something they want to put their money behind. But what regulation should do is try to prevent the purely bad actors.
So there we have it. The spirit of this regulation is to prevent fraud in principal actor situations, and the letter of the law is the Howey test. It's probably obvious to everyone listening, but still worth noting that stocks, bonds, ownership interests in mutual funds, hedge funds, etc., these things are all securities. So with this established, let's move to security tokens. To kick off this exploration, we'll feature a little audio from my conversation with Josh Stein from Harbor. I think what's interesting about this space, or perhaps what people find confusing is you're taking something that's already kind of complex and not well understood, which is tokens and blockchain technology, and then you're adding to that something else that's pretty complex and not well understood, which is securities laws, and then everything else that goes around that, including trading and settlement and all of those things. When you explain, I guess, at dinner parties, what security tokens are at their core, how do you explain it?
They're the same security interests you have today, only with an electronic wrapper. I think a great analogy is email to snail mail and what happened with written communications. So I can type out the same exact written communication. And 25 years ago, I would click print, put in an envelope, put a stamp on it, wait 2 to 3 days and have it delivered. Now I click send on an email. It happens instantaneously at almost no cost. The content of the written communication is exactly the same, whether it's an electronic medium or a paper medium. But the difference is once something's electronic and digital, I can send it faster, cheaper, and easier by orders of magnitude. Similarly with photography, whether I use film or whether I use a digital sensor, the photo of the object looks the same. What's different is, again, digital photography is orders of magnitude faster, cheaper, and easier to develop or use the images. And once in this electronic format, you can do a lot of transformative things. So similarly, when we tokenize or digitize securities, we can issue, but especially trade them orders of magnitude faster, cheaper, and easier. And that leads to transformative uses that we didn't do before.
There's definitely a group of people who I think misunderstand fundamentally what's going on, and they say things like, it's not centralized, the issuer has a lot of control. If theft happened or if shares need to be reissued, that could absolutely happen. I don't think anyone is trying to necessarily decentralize company ownership. So with that said, what do you see as the primary benefits of tokenizing a security versus what is arguably an electronic process already?
It's not an electronic process today. In the public markets, it is. And the public markets function very well. And in fact, tokenization does not offer huge benefits to the public markets. There are some administrative efficiencies in using blockchain technology. Settlement becomes faster and easier, and cap table management is more accurate. But for public securities today, shares in a public company, tokenization doesn't offer transformative value. Where it does is the tokenization of private security interests, which today exists only on paper and have zero liquidity. So the purpose of Harbor and the purpose of security tokens is to take some of that liquidity from the public markets, bring it to private securities through technology, and then you unlock tremendous value.
Hey, it's me cutting in here. So this is an absolutely key distinction that Josh just made. Security tokens provide enormous incremental value for publicly traded companies. But the real transformative value here is for private companies, which is what most of the world's securities are. For private companies, security tokens are a huge lever. Let's go back to my conversation with Josh. Let's then take an example, maybe a local coffee shop. Let's say my neighborhood here doesn't want Starbucks to move in, but the local beloved coffee shop is having problems. So the neighborhood decides that they're going to chip in and help the coffee shop do a fundraise. The coffee shop is going to issue security tokens with Harbor. As an example, is that a use case for what you're doing?
Yes, it is a use case. You can tokenize stock holdings in a private company. When you tokenize ownership of a private company, you get the administrative advantages you talked about, better cap table management, and you don't have the sort of double counting of shares and other issues that often happens in private companies. The real transformative use is unlocking liquidity, which investors value. I actually think private companies are a mixed use case. So for some private companies, tokenization of shares makes sense. For others, they don't. And I want to explain why. So what tokenization does is it brings liquidity. And so where you want to lock up the capital, but not the investor, it's a great solution.
Hey, it's me again, cutting here from the editor's booth to emphasize what Josh said. Most private companies lock up both capital and investors. That is, they make it impossible for investors to resell their interest in a business. Tokenized securities allow businesses to retain invested capital while making it easier for investors to enter and exit their positions in companies by selling their shares to others. Back to Josh.
Where you're sensitive to the cost of capital, where you want to gather in, or you have the ability to gather in investors, a broader investor base, particularly globally, tokenization is a great solution. Where you really care about the identity of the ownership, where you are not interested in a lot of liquidity in the security, tokenization provides some of the incremental administrative advantages we discussed, but it doesn't bring transformative value because the transformative value comes from liquidity. I think a great example of where this locking up the capital but not the investor becomes really transformative is think about investments that are long-term plays that are very capital intensive and where they're very sensitive to the cost of capital. Real estate is a great example. If you think about a private REIT today, REIT is a real estate investment trust. It's simply a C corporation that has special tax treatment depending on how it pays out dividends, and it limits its investments to real estate. A REIT is a common investing vehicle in real estate. So real estate's very capital intensive. It's very sensitive to the cost of capital. There's a real desire for investors to get into U.S. real estate worldwide. Today, they can get into public REITs, but those own huge baskets of properties. There's a lot of opportunities on the private side, but it's difficult to get into. Private REITs, like private securities today, there is no liquidity. And the reason there's no liquidity is because buyer and seller can't find each other. You have to repaper every transaction. And most importantly, there's fundamental transfer restrictions on those shares or interests. You can't just go sell them. Even if you do find a buyer, you have to go to the fund manager to get their say-so. And the reason is because there are very complex requirements, both regulatory and contractual, that the issuer has to manage. So the example of a private REIT is they have to have a minimum of 100 investors for tax purposes, not more than 2,000 when they have to go public. They have to have non-U.S. persons own less than 50%, and the top 5 shareholders have to own less than 50%. So what happens when you tokenize and what happens when you can apply those restrictions at the token level is that now buyer and seller can find each other and they can transact directly without having to go through the fund manager for prior approval.
This is a really interesting aspect of security tokens. I'd love to dig into what the law says here a little bit. As a founder, I'm familiar with Reg A, Reg D, Reg CF. I'm familiar with the obligations that I have when selling private company stock. I am not as familiar with what the law says about what a purchaser of that stock can do with regards to selling it to other people. So under the law, is the issuer held responsible for what a stock purchaser does in terms of buying and selling stock once it's been purchased?
There are certain aspects of it that rebound onto the issuer. So for instance, if you don't have these tight transfer restrictions on the private shares in a company and you end up with more than 2,000 shareholders, that company must go public.
Wow. So the SEC holds the issuer responsible for the actions taken, or for at least, regulating what happens with its own stock.
In some aspects, yes. If you're a REIT and you end up with less than 100 investors, you blow your favorable tax treatment. If you're an investment fund, those generally have a limit of 99 investors. If you have more than that, you have to go public. There are sometimes liquidity restrictions. There's things called publicly traded partnership rules, where if your LP interests in a fund are too liquid in certain ways, you can blow the favorable tax treatment for that investment fund.
Me again. So what Josh just said is a big deal. If you're a REIT or a company, having too many or too few investors can be a big problem. And going over or under the required number of investors can result in you being forced to go public or having to pay millions of dollars in additional taxes. That is, if you have too many investors, you might be forced to go public. And if you have too few investors, you might lose your tax status.
Also, there are special restrictions on affiliates of the issuer. So think not just subsidiaries, but think about persons who have a controlling interest or controlling influence in the issuer. It rebounds on the issuer on actions that they take. So there's a whole host of issues that the issuer has to control for. And the way they do that today with private securities, which exist in paper, is they put these tight transfer restrictions, and you have to go to the issuer and manually get a waiver. And then they have to go try and find the counterparty usually. So they may have 50 or 100 investors. They fax, they phone, they email, they expend a lot of elbow grease to find somebody. And as a result, when you have a private investment, if you need liquidity, it takes weeks or months, takes a lot of elbow grease. It costs you 10 grand to repaper the transaction. And then you get what's called the illiquidity discount. You get a hit on the valuation. The academic literature says that's 20 to 30%. In actuality, if you're in a hurry, it can be a lot deeper than that.
I can certainly see that, coming into play with artwork. There might be a painting that's worth 20 million, but if you want to sell that now, there's like 4 people in the world who might want it. And you probably won't, be able to make that happen without taking a huge hit. Hey, so this is a key point. Private securities often trade at a huge discount by virtue of there not being real secondary markets for them. This is known as the illiquidity discount. For more on this, we'll turn to my conversation with Professor Stephen McKeon. So in a lot of these valuation models, they let all the money that you would spend on attorney's fees and all these sort of expensive bespoke activities, or I guess maybe ad hoc activities that require human time, and they sort of move those to the balance sheet of these networks and let the money that you would spend on fees kind of accrue to the network value. And I think another interesting idea is kind of around liquidity and how something being more liquid actually increases its value. I've heard economists talk about one of the reasons why tokens are so expensive, or why we've seen sharp rises in the prices of Ethereum and Coin and other crypto assets or crypto commodities, is because there is liquidity, and that in and of itself adds to the value of the asset. Do you think, as an economist, putting your economist hat on, do you think tokenized properties, or do you hypothesize that tokenized properties will be worth more because there is that liquidity that comes with tokenization?
Yeah, it's definitely part of the thesis. It's a central part of the thesis, is this idea of a liquidity premium, or I should say mitigating the liquidity discount. You touched on 2 things there in that question. So there's a couple baskets of shifts in value. So one is just becoming more efficient, right? So taking some of these costs that are involved in transactions and automating them to some extent, which just makes it easier to transfer these things and reduces the kind of direct transactional costs relative to moving value. And then another idea is this idea of liquidity premium. So if you just break it down and you think about, why does this thing exist? When we think about measuring liquidity, we often look at, so what economists do, financial economists will look at price impact, right? So if I need to sell this thing, say I own an asset and I need to sell it right now, how much would I have to discount the price, or how much would the price move because I'm executing this trade? So you can kind of measure these things with like a bid-ask spread, or, you can look at, how much did the price move in response to a particular trade. So if I'm an investor and I know that once I buy this thing, there's going to be price impact when I want to go sell it at some point in the future, what that means is I'm not going to pay as much for it today because I'm anticipating that cost in the future. You can just kind of like follow that all the way through the chain and sort of understand why the illiquidity discount exists.
That makes complete sense. And I can see the liquidity premium applying to things other than maybe sort of traditional securities, into things like artwork. There might be a very rare piece of artwork and maybe it's valued at 100 million or 150 million. And that might be the value, but there's like 10 people in the world that would be willing to pay that much for that piece of art. But once you have a scenario where there's fractional ownership and there's liquid markets around it, now we might get more accurate pricing in those instances. Is that something that people are contemplating around this space?
Absolutely. And so the idea that you're touching on there is something called market depth, right? And market depth is an integral piece of this liquidity premium idea because, as I've said before, just because you tokenize an asset, that doesn't automatically make it more liquid, right? So It only becomes more liquid if it also increases market depth for the reasons that you touched on. So if you have a high unit value asset and there's very few people in the world that can sort of, wrangle the resources to purchase that asset, but if you were to fractionalize ownership, you now get a much larger pool of buyers, then you've increased market depth and you've potentially increased liquidity. Like, transferring that value will be less impacted by the trade because there's more buyers out there that are interested in owning it. So yes, that's a really important piece.
In addition to discussing the impact of security tokens on private companies, we should also discuss the impact on public ones as well. Here to discuss this with me is Bruce Fenton, a Wall Street vet who's been an asset manager and stockbroker for over 20 years. During this period that you've been involved in this highly regulated industry, how has trade execution changed?
A lot of people don't really understand how things work. Some of the big changes, when I started, they had what's called T+5 settlement. So it was 5 business days. So if you had a weekend, well, you always had a weekend basically because it's 5 business days. And then sometimes you'd have a holiday or something like that. You could end up taking a good part of a week to get your trade settled. And then that moved to T3 and now T2. With blockchain technology, you can get that down to, basically minutes. And that's why the T0 chose the name T0, 0-day settlement. So the industry has moved along, but not very fast, going from, probably, I don't know how long T+5 was there before I came in, but I think it was decades probably. So going from 5 days when I started 25 years ago to 2 days isn't a really big change when you can have the technology that a blockchain has, which can enable that to be done in 10 minutes.
What intelligence or analytics have issuers historically had about their shares, the liquidity of those shares, holders of those shares, whales, etc.? What has been known by companies about what is being done with their stock?
They don't know anything. For public companies, they don't know anything. And that's a really important thing to note because a lot of people in the blockchain Bitcoin space are from startup environment. So they assume that everything works like startups. They assume that, you're a company, you do a round, you do another round, you have a database, you have your cap table, and you know who owns what. That is not the case for publicly traded companies. When we talk about taking on Wall Street, when we talk about truly disrupting the global financial system, we're not talking about a startup raising $30 million. We're talking about a completely different type of scenario. And up until recently, there's been a very, very big difference between private companies and public companies. That's why it's been so hard and expensive to become public. That's why you need so many professionals and other people involved. And there's so many intermediaries, some of which add value, some of which don't. But there's tons of lawyers and exchanges and regulators and brokers and transfer agents and all kinds of things like that you need in that system. Yeah, it's important to note that it's 2 different things, basically.
Yeah. And so I guess within that system, and you might not know the answer to this, but within that system, how do they do basic accounting around outstanding shares? They can certainly know what they've issued, but, if they do want to find out what's in circulation, you mentioned something that happened in 1996 with the DTCC. Could you speak a little bit to that?
Yeah, that's an important point. So what happened is it's very hard if you're thinking of it from a startup angle, as a lot of people do, they say, okay, you have a company, the company tracks who owns what, and people have their shares, and they can change it. If somebody changes it, the company can change that out. So people who think of it that way don't see the advantage of a blockchain. And there's a lot of critics who will say, and I've spent a lot of effort trying to explain why this is incorrect, because these are typically very smart people who know a lot about blockchain. Some of them are Bitcoin maximalists. But on this particular subject, they're wrong because they're misunderstanding what is being solved for. They're assuming that a blockchain is going to solve for making it so that the company doesn't have to keep the database. But that's not correct. The company never kept the database. So to answer your question, the way that public companies do it now is a real mess. What happens is Apple doesn't know who their shareholders are. They have no way of really getting that. And the reason they can't know that is because there's millions and millions of transactions a day. You'd need a department of 100 people at Apple just to figure out who owns what. And it would never work because they'd have to interact with a whole bunch of other people. And a lot of people who think that a blockchain is a solution, they say things like, you just have GPG keys, or all these other centralized solutions, but those won't work because, again, it's not the issuer that actually keeps the database because there's so many trades. You have all of these brokers involved. So who keeps the database? Who keeps the list of who owns Apple? Well, nobody really. It's a distributed database, which kind of sounds good at first, but until you look into how it actually works, it's distributed, but also centralized. So it's distributed in the sense that Merrill Lynch knows how many shareholders own Apple at Merrill, and Morgan Stanley knows how many at Morgan, and Goldman knows how many they own, but they don't tell each other. They don't communicate with each other. So what happened is this got so untenable, and they couldn't even keep track of who owned what. So throughout the 60s, 70s, and 80s, 90s, they would drive around in bicycles and deliver certificates between offices, and then they'd have interoffice couriers and messengers. And so Goldman would net it out at the end of the day, and Merrill would net out this, and people would transfer physical shares between offices. They did that all the way up until the 80s and 90s, basically. And then they tried to create a system that would be more electronic and more modern. But the thing is, Wall Street doesn't sleep. It's constantly going. So you can't just shut it down for a year and build a better system. You have to just constantly build and build. So the system that's built now has been built layers and layers on it going back over 100 years. So a lot of the things that we have are legacy systems that are going back from the 50s, 60s, 70s. So in 1996, this capacity issue, you could call it the capacity debate on Wall Street. There wasn't much of a debate about it, though, because they don't think about things like decentralization. They said, all right, this isn't working. It's a big mess. We can't figure out who owns what. There's fake shares being issued. There's all of this stuff. Merrill Lynch and Morgan Stanley won't communicate with each other. Nobody knows who owns what. Companies, in order to send out a proxy statement or a voting statement, have to hire a consultant company who can come in and figure out who the shareholders are so they can send it, which they're legally required to do. So they trusted a third party to do that. So in 1996, what they did is they said, well, let's just put everybody's money in one name. Forget about trying to pretend that this is Bob's stock and Susan's stock and ABC company stock and Bruce's stock. We'll just put it in one name. We'll put in one big company name. We'll call that company CD & Co. And we'll make sure that it's protected by having a whole bunch of complex legal trusts and documents and stuff to make sure CD doesn't steal the stock, which they haven't. But CD will have all the money. And then the DTCC, the Depository Trust Company, will work with them in a complex system to figure out and net out at the end of the day or the end of the week who actually owns what. And when those brokers want to contact us and figure out who actually owns what, and we settle up, they can do that through centralized parties like DTCC. That's the system that exists right now. It's a distributed but centralized ledger. It's distributed because there's a whole bunch of parties, there's brokers, transfer agents, issuers, a whole bunch of other people and organizations involved, exchanges, everything else. But they haven't had any way that they could solve the Byzantine generals problem and trust other people. So they just put it in one organization, and they all kind of agreed that they would trust that organization. Some aspects of it have worked better than the old way, certainly, but it has a lot of drawbacks. For example, right now, to go from broker to broker, it takes between 2 and 3 weeks or more to transfer your shares. So even if you're going from one department of a company to another, you could go from within Merrill Lynch to another part of Merrill Lynch. It could take 10 days to move your money. If you're Amish, or you don't have a driver's license, or you changed your address, or you're part of a trust or an estate, or you had a divorce, or you had a death, or any number of 100 other things, your I isn't properly dotted, that 3-week period can stretch to 4, 5, 6, 7 weeks. So it's very common. Pretty much any broker will have some horror story. If you say it's called the ACAT process, is the internal system. And by the way, when I talk about DTCC and ACAT, sometimes I've mentioned that, and people say, oh, you're trying to just replace one company. This isn't just one company. It is the entire industry. It is all brokers. It is all publicly traded companies in the United States. This isn't some little billion-dollar company out there that somebody's trying to displace. This is trillions and trillions and trillions of dollars. It's all the money in all the system, pretty much. There are a couple very, very rare examples where certain founders will have special 144 stock that's not listed and they control it themselves. And maybe, Elon may have his own shares or something, but generally, even those examples are rare. So pretty much all the stock in the world, certainly if you're a stockholder, any of your listeners, people who own stock in their 401k, even multimillionaires, even decamillionaires, even billionaires, I've served billionaire clients for years, all of them, same way, it's in the same system. So you could talk to brokers about this ACAT process and say, what's the worst ACAT you ever had? And everybody has a horror story. Sometimes it takes 11, 12 weeks. I had a client where they had a death in the family and, death certificates and stuff like that could take weeks and weeks and weeks. Whereas with a blockchain type asset, it'd be instant.
That's super interesting. I think most people, because the infrastructure around it appears to be very efficient, they don't see what happens on the back end of those trades. Maybe Scottrade said that you purchased something, but you don't have it yet.
Yeah, you don't actually own your stock. When you open a brokerage account at Charles Schwab or Scottrade, you have 12 pages of documents. When I started in the business, this is funny. This shows how the industry has changed. When I became a broker in 92, you could open an account over the phone with no ID, and you didn't even need any money.
Wow.
They had the same 5 business days settlement. They had 5 days to get the money in. So you could literally have somebody call in and say, hey, I want to open an account. I want to buy IBM. They could buy it. You just took down their name and address, and then, hopefully they paid you. So it's funny. As crazy as that is, there was very few cases of fraud. Because what you could do, obviously, with that, you could front run. You could call 5 brokers and short sell IBM at 5 of them and buy it long at IBM at 5 of them. But surprisingly, those things didn't happen. I think it happened, it's kind of thing happened once every couple of years. You're going to have fraud in any business, but it wasn't as common as you think. People tend to kind of know, brokerage was more community-based back then. You had a stockbroker and they could spot something that seemed unusual. And we'd have unusual trades that people would come in. But nobody actually owns the stock that they think they own. If you have accounts at a brokerage firm, when you read those 12 pages in the back, you'll see that you don't actually own it. You have these pledges and hypothecation agreements, and your actual share or legal ownership. If you were to have a certificate, if you were to go to Apple and request a certificate, which I don't think they'll do anymore, but if you could, it wouldn't have your name on it. It would have CD & Co.'s name on it.
So thinking through what security tokens actually solve for, it seems like there's a number of things that it solves for. One, it solves for analytics on the part of the issuer. 2, it solves for inefficiencies with the current infrastructure. It seems like for issuers, it also solves a liquidity problem. And for investors as well, it solves for a liquidity problem. This isn't about turning shares of your company into Bitcoin. All the normal laws still apply, all the normal regulations still apply. In your view, what are the main categories of problems being solved through security tokens?
That's a great question. And a lot of people misunderstand what the problem is, especially if you go back to that example I mentioned of people looking at the startup environment, assuming that you're solving for a company database, saying, well, it's already centralized anyway, which is true. Companies are centralized. So if you have Disney and Disney stock, Disney's centralized. It's a place. It has a CEO. It has headquarters. It has offices. It has parks that you can go and visit. That's always going to be centralized, at least in the foreseeable future. Maybe, in a couple hundred years, somebody will figure out another way with VR or something. But for now, all companies that we know in general corporate law and the general world of the global economy are centralized. So you're not going to decentralize a company. There's no way that a blockchain can become aware of Disney or Apple or anything else. So that's not what it's solving for. What it is solving for is the custody issues of how equities, how stocks are actually held around the world. And in the case of larger publicly traded companies, it's a very complex, messy, confusing system that I just mentioned that has lots of layers that don't make any sense and don't need to be there. And what those layers do is they cause a lot of inefficiency. It takes you a minimum of a week or 2 to move your money from one broker to another. I'm not talking about trading. Another misconception people have is they mistake trading and custody and asset movement. Wall Street is very good at certain tech. They can trade millions of shares in a second. They have huge, robust capabilities to do high frequency trading. Trading is different from settlement. They're not actually moving the money. It's kind of like Coinbase when they do off-chain transactions. If you're doing transactions within Coinbase, that doesn't show up on the blockchain. If you send money from one Coinbase user to another and then they trade it back and forth, that doesn't show up on the blockchain. That's an internal Coinbase thing. So the current movement, all this high-frequency trading is what we would call, it will become off-chain transactions, basically. It will be done by brokers using the existing technology and systems that they have. The money won't be able to be moving. When a high frequency trader, somebody who does 80 trades of a stock in a day, they're not actually sending shares to somebody and back. They're just making a marker to figure out what settles up at the end of the day. So it will solve for that, which will make it much more efficient to move money around. It's not going to change the high frequency trading thing, but it will make it easier for money to move around. The other thing it will do, it'll give people more control of their own money. You asked if I had stock certificates. Almost nobody has them anymore other than for small companies. Publicly traded companies very rarely issue them. They're really not used. Brokers don't really recognize them. Most of the younger brokers now who came in 10 or 15 years after me have probably barely ever seen these certificates. So we're not solving for the trading aspects, and we're not solving for a company database. We're solving for this overall complex system of intermediaries which don't add value, that add a lot of delays. So we're making that more streamlined, more efficient, and that's what a token can do. And what that does, it enables people to control more of their own money, which is, if you believe in Bitcoin, then you should believe that people should control their own wealth. You have a lot more liquidity options and things like that if you control your own money.
One of the new liquidity options that comes with security tokenization is the option for public and private security token holders to sell their tokens in a peer-to-peer fashion. A lot of early adopters report buying their first Bitcoins at a coffee shop or over eBay from another person. Unfortunately, these types of transactions aren't possible with securities right now, but not because peer-to-peer transactions are prohibited by the law. Back to Bruce Fenton to explain more.
You have the right to sell your property. If you own Apple shares, you can sell those to me legally. People don't understand that. They've been so beaten down by this system of compliance and laws and nonsensical rent-seeking intermediaries that they've forgotten something as basic as the fact that, if you own your own property, you don't need a broker to sell it. You could sell it to somebody. It's going to be very, very interesting to see the rise of decentralized exchanges. And if you look at the wording and the way that a lot of the laws are written, as soon as the SEC really figures this out, and some people there are quite smart, and so they probably already figured it out, it's a big deal for the way that things will work because you're not going to need exchanges much. The biggest control point that they have is issuers and exchanges. Issuers is pretty easy. Just comply with the law and either be exempt or register or make it not a security, or you get in trouble. Those are your four options. But the secondary market is going to be a very interesting thing. And that's where I've been focusing most of my efforts for the last 3 years, because I saw this secondary market as being the key. I think a lot of these ICOs are missing the boat. They're focusing on the primary market, which is a big pain in the neck. And a lot of them are going to get in trouble. But once you get the shares out there, and if they're legally issued the first time, people can do whatever they want with them. I can buy a share of bearer stock, if it exists anymore. I can buy that from somebody. And I can make a deal with somebody at a coffee house to buy their Apple stock. Now, the problem is that the systems, not the law doesn't have a problem with me buying Apple stock from somebody. It's the systems that have a problem.
As long as it's public. If it's a private placement or like Reg D or something like that.
Yeah, well, if it's Apple, it's already public. The trick with Apple is that you need to have a registrar and everything say that you actually own that. Or you'd have to have it in some kind of vehicle or something like that. There isn't really a way to have somebody else own it. But with a blockchain token, then ownership would be determined by whoever controls the private keys.
So we've spoken about the benefits of security tokenization for public and private companies, but it's important to note that tokenization isn't a great fit for everyone. For example, venture-backed companies are just one kind of company where tokenization might not make sense. Here's more from Harbor CEO Josh Stein. When you think about maybe venture-backed companies or, startups in general, what do you see as the pros and cons of going this route, and what might a startup founder think about when they're going to do a raise? At what point should they start considering using a security token, and how would they go about doing it?
So I think security tokens actually do not offer transformative value for what we think of as a classic high-tech startup. That's because those startups are not capital constrained. They've got far more people wanting to invest and far more potential capital than they can take on. They're being choosy about their investors, and they certainly don't want their investors to freely trade. So you can tokenize for some better cap table management, but you would not, as a company, lift the transfer restrictions on those investors. You wouldn't want to. But I think what we often forget is that the high-tech startup that's got more capital than it knows what to do with is a tiny fraction of a percent of all the companies out there in America and around the world. So your typical company is the neighborhood coffee shop. It's the franchise of auto body shops that needs capital to expand. It's real estate investments that are capital intensive and sensitive to the cost of capital. Anywhere where you are relatively indifferent to the identity of the investor, but you're sensitive to the ability to raise capital and the cost of that capital, that is where the transformative use of tokenization comes in. Eventually, every private security will tokenize because there is inefficiencies to wring out. You do need liquidity sometimes, and tokenization enables that. But if there's going to be very little trading, then tokenization doesn't offer anything particularly transformative. On the other hand, if let's say you're trying to gather investment in real estate, let's say, to use a good example, you've got a beautiful Class A office building. It's worth maybe $50 million in a major metropolitan area. It's on the National Historic Register. There are tons of people around the world who would love to get into U.S. real estate, who'd love to be able to invest at the asset level in a single asset, something they can touch and feel and understand. And so today in paper, they would never hear about it. They'd have no practical way to get into it, and they would have no liquidity, which is really daunting. But if you tokenize, if you now make this digital and it's faster, cheaper, and easier to gather in a larger worldwide base of investors, and if it's faster, cheaper, easier by orders of magnitude to trade that later to get the liquidity people want, suddenly you can raise far more capital from far more people at a lower cost of capital. And that is really transformative to that industry.
So we're about to get into the nitty-gritty details around use cases and how security tokens work. But before we do that, it's worth taking a second to take stock of the benefits of security tokens that we've encountered thus far. Security tokens, 1, increase liquidity and market depth. 2, give control back to security owners. 3, increase the number of liquidity options for security owners, such as peer-to-peer exchange and decentralized exchanges. 4, remove rent-seeking intermediaries. 5, maintain the cap table for private companies. 6, provide cap table analytics to public companies. 7, allow for fractional ownership of property like paintings. 8, reduce settlement times from 2 days to minutes. And 9, make it cheaper to go public. Almost all of these benefits fall under the category of cheaper compliance. By allowing regulatory compliance to scale without rent-seeking intermediaries and reducing the number of hours required from expensive service providers like accountants and attorneys, security tokens allow smaller companies to afford the kind of regulatory compliance that's previously only been available to the Fortune 1000. Here's Professor McKeon with more on this.
In all cases where you see regulation, there's some effort to sort of keep things on the up and up, right? But the problem is that the regulation can create friction. And so I think moving forward, the goal, and this would be, what Harbor's working on as well as many others, is to try and make the regulation not so cumbersome, right? So kind of work within the existing environment, but make it sort of easier to comply with the regulation. So Chris Burniske recently wrote about the need for regulation to scale as crypto space scales. And I think that's right. There are two ways to think about that. One is maybe we need new bespoke regulation around securities. I think this is what he was getting at. But the other idea is that we need systems to scale the regulation we've got. And so I think that's where things like Harbor's R token protocol come into play. So in other words, using the existing regulatory environment, but making it less cumbersome to comply.
Professor McKeon's thoughts on this are important. One of the main criticisms I've heard about security tokens is that they won't do for securities what Bitcoin did for money. These criticisms, I believe, miss the point. Efforts to tokenize securities aren't an attempt to turn equity or real-world assets into decentralized digital cash, and it's a mistake to consider security tokens through the lens of Bitcoin. Instead, one should think of security token infrastructures as providing cheap, scalable compliance. At their best, security token technology provides open-source protocols for frictionless trading and increased liquidity outside of proprietary walled gardens. Here's Josh Stein from Harbor with more.
The fundamental value prop of Harbor is compliance as a service. There's additional layers of value that get built on top of that, but that is the fundamental layer that has to operate or none of it works. If you can't ensure compliance with the securities laws and contractual restrictions at the token level, wherever this trades, then everything else doesn't work. It's the foundation to the building of value that we're building.
That's fascinating. I know of a SaaS company that does HIPAA compliance as a service. And so maybe another way to think about what you guys doing is it's securities laws compliance as a service. It's very cool.
It is, because to get secondary liquidity on tokenized securities, you need to be able to ensure that they're trading compliantly no matter where it is, 24/7, 365 around the globe. The only way to do that is at the token level. And those controls have to work reliably. Once you have that, then you can lift the tight transfer restrictions on the tokens and you can allow them to trade as liquidly to the limit of the inherent limitations of the investment. But if you don't have that compliance as a service, you don't have that compliance baked in at the token level, that can't happen.
I think a lot of people think about the blockchain as a trustless system, and then they go to securities tokens. They're like, well, this isn't a trustless system. But I think what they're missing out on is that the trustlessness doesn't need to happen necessarily at the protocol level. It needs to happen at the liquidity level. Can an issuer allow people to trade amongst themselves in a trustless manner when the stakes or the cost of non-compliance is so incredibly high to a business?
That's correct. Compliance can't be trustless. If the compliance is provided, the rest of it can then be trustless. Then you're in this great decentralized world in which buyer and seller can trade 24/7, 365 around the globe with instantaneous settlement and no counterparty risk.
Yeah, because the cost of waking up one day and realizing that you have to go public because you have more shareholders than you would like or whatever, like that's just a really bad place to be in.
Yes, or that all your investors are subject to 30% tax withholding.
I live in Minneapolis. It's not a startup hub. What's an example of maybe a business that would be in a, sort of that average Midwestern city that's not real estate that would most benefit from security tokens? You mentioned like an auto dealership. What do you think is like kind of like the prime candidate for this use case?
I think folks who are looking to expand or franchise. So whether it's restaurants, auto body shops, whatever it is, you've got say 5, 10 locations. You have a business model that works, but now you need a ton of capital to expand. If you go get capital from 1, 2, 5, 10 investors, they're going to bargain for some really hard control rights. They're going to take a big chunk of your equity. You may not be able to get the amount of capital that you want. When you tokenize, it's easier to advertise out, do a general solicitation out to a broader base of investors. It's easier to onboard them. You should get a better cost of capital because liquidity brings value. So if you think that the liquidity discount is 20 to 30%, if you can eliminate half of that, that means your cost of capital should be roughly 10 to 15% lower, or the price that you get on those shares should be 10 to 15% higher. For all those reasons, those are great examples where tokenization should help.
So not only do you give up less control, but you also gain a liquidity premium and potentially a higher valuation. That's fantastic. What do you think are the downsides for that business that's looking to franchise? Do they lose anything through going this route?
What you lose is once you pull the transfer restrictions and you allow these shares to be freely traded, you have now lost control over the identity of your investors. You don't have to do that, but the more tightly you control the investor base, the less the liquidity, the less value that tokenization is delivering. Those are two fundamental trade-offs. So to give an example, Harbor can enforce custom whitelists because we always know the real world identity. So you could say that, you know what, I'm going to vet investors coming into the company, and then I'm going to let existing investors freely trade amongst themselves, but I'm not going to allow someone new onto the whitelist unless I've approved them ahead of time. So that's great. That would allow, and if you think of a large startup like an Uber, you could imagine a fair amount of liquidity and trading going on in all those different shares. But for a much smaller company, you don't have a large number of investors, you're not going to have much liquidity. I think what becomes really interesting is what happens if, say, the top 100 VC firms and PE firms all decide that in their investments going forward, they want to insist that they can freely trade amongst that group of 100. So now they can get liquidity. There's a fairly diverse base of people that they can freely trade in and out fairly well, but it's not wide open to any person around the world who's unknown, who may be litigious, or who you may not want to share financial info with. So there are varying ways to go about it, but the fundamental trade-off is the greater the potential pool of investors that you allow and the more freely you allow them to trade, the greater the liquidity, the greater the value that you're bringing. But the trade-off is less control over the identity of those investors. So fundamentally, we think that the best candidates for tokenization early on are where you want to lock up the capital, but not the investor.
Security tokens represent ownership claims in all the things you'd normally think of as investment vehicles: stocks, bonds, treasury notes, mutual funds, LP interest in funds, etc. And this is important because, as Bruce Fenton reminded me during our interview, only 1/3 of the world's wealth is in cash. I'll let Bruce close out part 1 of this documentary with a reminder of this.
Only 1/3 of the world's wealth is in cash. So we're fighting this great, valuable, noble fight to say, let's make Bitcoin or things like Bitcoin become the new global reserve currency. Wonderful. I'm all there. But it's only a third of the world's money. Even if you win, you still haven't changed the whole global economy. You need to give people that kind of same power for their equities.
This concludes part 1 of Tokenize the World. In part 2, we'll be digging into the nitty-gritty specifics of how security token issuance and exchange works with the founders of Harbor and Polymath, 2 of the top security token standards. Stay tuned. This podcast was produced by me, Clay Collins. My audio producer and collaborator is the talented Arison Kane. Special thanks to our guests and everyone who helped make this series possible. If you have questions or comments, you can contact me on Twitter at Clay Collins. Thanks for listening. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.